Hello, everyone. Welcome to our first webinar in our series coming out of our annual TSX60 proxy review. My name is Emily Parsons. I'm a manager in Hugeson's Toronto office, and I will be your host for today's webinar. As we begin, I would like to take this opportunity to acknowledge the Indigenous peoples of the lands by talking about our firms and my personal commitment to reconciliation. We are committed to learning more about the Indigenous cultures, histories, and traditions of the Indigenous peoples of these lands and finding opportunities to contribute to reconciliation, both between Indigenous people and settlers. I make these commitments to reconciliation both personally and on behalf of Hugeson Consulting and encourage our listeners to do the same. I'd like to give my colleagues the opportunity to introduce themselves, so let's go around the screen here, starting with Kira.
Hi, thanks, Emily. I'm Kira Wakita, and I co-lead our nationwide board effectiveness practice. Our mission is to help boards better their odds of making good choices, and we support boards with board effectiveness, board evaluations, CEO performance management, and CEO transitions.
Hi, I'm Julia Hunt. I'm an associate in Hugeson's Toronto office, and I work primarily in our executive compensation practice. I work on a range of different mandates for both private and public companies across a breadth of industries, ranging anywhere from mining and metals to telecoms to some of the country's largest pension funds.
Hi everyone, my name is Rachel Keat, and I am a senior consultant from the New York office in Sumner Brossi, which is a U.S. executive compensation consulting firm. We are also happy to say that we're Hugeson's U.S. affiliated partner. And so beyond normal executive compensation work, I also help lead some of the ESG thinking and research at Sumner Brossi. And so today I'll be providing a U.S. perspective on today's webinar.
Thanks, everyone. So today our topics are ESG and board governance, and our conversation will be structured as a panel discussion between myself and my colleagues here. Before we get started, a few housekeeping items. So all participants are in listen-only mode. Questions can be submitted through the chat feature on the left-hand side of the screen. It looks like a little speech bubble, and we encourage you to submit questions as the session proceeds. And finally, just to get this question out of the way, today's slides and recording will be posted on our website following the session. So with that, let's get started. Kira, I'd like to set the stage for today's discussion by asking about high-performing boards. What is a high-performing board, and why are we having this conversation today?
Yeah. Well, the first condition of being a high-performing board is that you govern a high-performing organization. And I think sometimes we lose sight of that. I think we often talk about good governance as a set of inputs. Things like we are independent, we are diverse, we are a collegial board, we focus on strategy. And those are probably all really good things. And really, that's actually what we're talking about today. And it's because we have little research and little empirical evidence about what really makes boards highly effective. And I mean, after all, governance is a social science. And what we can measure is what's disclosed, and we'll be talking about the TSX60 today, but I don't want to lose sight of the fact that all of this is in service of organizational performance. It's in service of helping boards determine the levers that make them strategic assets to their organizations. And ultimately, I think we're in collective pursuit of a more prosperous Canada, like a Canada with responsible, inclusive, and sustainable cultural fabric. And I think that's ultimately what we collectively should be solving for.
Thanks, Kira. And so how do boards know that they're doing this? How do they know if they're serving as a strategic asset to their organization?
Yeah. Well, it is incumbent on boards to look inward and figure this out for themselves. And the most common method of doing this is in the format of a board evaluation. Now, on the TSX60 this year, in our proxy reviews of this past proxy season, all of them, all 60 companies disclosed that they undertake some form of board evaluation. And last year, we actually did a similar exercise of the entire TSX composite, which will be coming out later this summer as well. And 97% of organizations or boards said that they undertake a board evaluation. So that's not new, but there are some trends that are occurring within that. And so I'd say the first trend that we're continuing to see is that it's becoming more and more common to use interviews as part of your board evaluations. In fact, it's more common to use interviews than to not use interviews. Nearly half of boards are now using interviews to complement their surveys or their questionnaires. And I always say, if you're limited on time and you only have the bandwidth or the capacity to do a survey or an interview, choose the interview. It's far more insightful. And the context and the dialogue is actually what matters in this process. I think the other trend that we are continuing to see is management feedback. And so about a quarter of the TSX60 this past year used management feedback to understand, are they adding value to the organization? Now, that said, management can be tough critics, although it can also be very insightful. According to research recently done by PricewaterhouseCoopers, only 29% of executives rated their board's performance as good or excellent. Further, about 9 of 10 executives think that there's at least one director that should be replaced, and we'll talk about that later in the podcast. But overall, I think that's a really strong practice, and we're starting to see more of it. About 90% of boards are using peer feedback. That's not new, and those tend to be very insightful for directors, especially as a board matures and directors gain more trust amongst each other and start to give each other really constructive feedback. And then the final trend that we're continuing to see is around the use of third parties. So this past proxy season, about a third of the TSX companies used a third party, and many others indicate that they use a third party, if it wasn't this past year, perhaps every couple years or somewhat periodically, to make sure that they're covering the whole waterfront. I think ultimately, it's the board's responsibility to ensure that they're looking inward and assessing where they can pivot to add more value and where they can change the conditions in which they're operating to better their odds of making good choices. I'll add that, in as much as we use the word evaluation and third parties, it's not on a third party to assess or to judge. I think the use of third parties in this context is to make sure that the boards are asking themselves the right questions, that we're presenting structures and facilitating the assessment in a really robust way.
Thanks, Kira. And so coming out of a board effectiveness review, if a board is looking to up their game, what are some of the things that they should be thinking about?
Yeah. I think as a general statement, high-performing boards are the right people focused on the right topics or focused on the right things. There's a lot of stuff that we talk about in governance and around process, things like, meeting cadence, meeting durations, facilitation, airtime of directors, materials, and all of those have potential, I think, to add incremental value. But I would say that the single biggest question is, do you have the right people on your board, and are you talking about the right things?
And when you talk about the right people, that very naturally brings up the question of board diversity.
It does. And I think board diversity and board composition is probably one of the most hotly debated and most discussed topics in governance right now. And so maybe we could look at just some stats from the TSX60 this year that we have on screen. The vast majority of TSX companies have some commentary on a diversity policy. That's table stakes, and generally it discusses a philosophy of how the board thinks about diversity, women on board, and historically underrepresented groups. When it comes to having firm targets, quantitative targets on diversity, it's different. And most boards, 86%, have targets as it relates to women. So most boards would say, okay, we want to have 30%, 35%, 40% representation of women. But it's a different story when it comes to visible minorities or other historically underrepresented groups. Only 21%, or about 14 companies, have actual targets around that. And I think we'll start to see that change with recent guidelines that came out from ISS. ISS recently stated that for meetings after February 2024, so less than a year from now, they'll be recommending against the chair of the nominating committee in cases where there's no apparent ethnically diverse members or no targets or commitment to do so. And so as you think through your proxies for next year, and more importantly, your policies and your targets for next year, if you want some guidance, check out a few companies that already have formal targets. That would include Intact, Pembina, TELUS, and Sun Life. Might be some good references for you.
Great, thank you, Kira. Well, Rachel, I'd like to turn to you. What are we seeing with respect to board diversity in the US?
So I think it's rather similar to Canadian trends. There isn't really a formal target how many diverse directors are, actually on the board. However, based on a report by Spencer Stewart, approximately 50% of boards in the S&P 500 have some type of policy when it comes to the actual director recruitment policy process. And so basically, boards have a policy to include at least one diverse individual in the candidate pool when selecting new directors. And so as we look at the new director pool in 2022, for example, approximately 3/4 of that pool was diverse. And so a step in the right direction when we're looking at the resulting director composition.
Great, thank you. Staying on this topic a little bit of board composition, we know that there is this pressure that directors are under to make sure that they have the appropriate competencies and skills represented. And as we're seeing, the company's strategies begin to include ESG, the natural question is, how is progress on that front incentivized? So in other words, how is that reflected in the compensation programs? Rachel, I know that Semler has looked into this. Why are companies choosing to integrate ESG into their compensation programs?
There's a lot of reasons. Our formal stance is that it should really be strategy focused, right? Strategy comes first. If ESG is important to your strategy, and there's reason to link compensation to ESG. But we did do a kind of an informal poll during our collaboration with Conference Board and ESG Gauge at a roundtable last year, and directors were able to select the factors driving ESG and compensation, as many as applied. And so no surprise here, the top two at 90% and 67% is more about responding to external pressures. There's a lot of pressure right now over the last few years. And so signaling that ESG is a priority and then responding to what shareholders want is kind of top of mind for directors. The other important one is that 56%, that third category right there, achieving or connecting back to the ESG commitments that your firm has made. And so again, this goes back to the strategy piece, right? How important is ESG to your company, to your business? And then what are some of the commitments that you've made outside the compensation program, and how can you use the program to help support those commitments?
And that's really helpful, Rachel. I like the fact that you raised that this should be a conversation that boards have before they integrate ESG into compensation. It's really getting back to what is the purpose and what are the guiding principles of incorporating ESG? What are they trying to accomplish? Ultimately, we tend to agree, of course, the purpose of compensation is to drive strategic outcomes and align pay with performance, and that would be the same for ESG. And I noticed that you raised a whole bunch of different stakeholders in this Q&A here. You have employees, customers. Julia, could you share a little bit more about the various market forces that are part of the discussion as companies advance their thinking on their ESG strategies?
Absolutely. So there are a number of market forces at play here, and this tends to vary a little bit by geography. In North America, shareholders have historically been a little bit more of a driving force, whereas in Europe, for example, the government has had a bit of a greater influence. However, we've seen the government and regulators take a more active role in North America in recent years with the recent requirements of enhanced climate and diversity disclosure for a wide range of companies. Proxy advisors and member organizations also play a very active role in this landscape, as well as other key stakeholders, including a business's employees and customers.
And, given the focus on shareholders in North America, could you tell me a little bit more about the ESG pressures that we're seeing from that side?
For sure. So over 95% of shareholder proposals this year have interestingly been focused on ESG related topics. This year, there was an emphasis on environment related proposals, which saw a 10% increase year over year. Though it is worth noting that nearly all proposals were withdrawn or failed when put to a vote, in line with what we've seen in previous years. But this being said, although none of them passed, it's interesting to note that one of the most prevalent topics among proposals was the disclosure of emissions targets. As well, all of the major Canadian banks received proposals regarding the adoption of an advisory vote on environmental policies, otherwise known as a say on climate. And these received support ranging from 16 to 21%, which is notable traction.
And Rachel, how does this compare to what you're seeing in the US with respect to shareholder perspectives?
Yeah, so I think if we flip to the next page, looking at this chart, I think it's important to note that our data here reflects up to mid-May in the US. And so, while we look at 2021 and 2022, we see a big influx of E&S proposals. 2023 is likely to continue on that trend. So when it comes to the actual outcome or the support levels of E&S proposals, we have seen that median support has decreased by 5 percentage points for social proposals and 4 percentage points for environmental proposals. This is a continuation of a downward trend in median support for these proposals, which could likely be just due to the extremely increasingly prescriptive nature of the proposals going up for vote. I think what's more interesting to note so far is that we have 4 proposals in the US so far that have received over 50% support. And I can just kind of quickly go through them. The first one is Expeditors International Washington, who received 57% support on a proposal asking for a reporting on D&I efforts and outcomes. Wells Fargo's received a 52% support for asking to report annually on the effectiveness and outcomes of anti-harassment and discrimination policies. Starbucks received a 52% support for an independent assessment of its labor practices, which has been on the news as Starbucks has been having back and forth with workers unionizing. And then the last one, Coterra, received nearly a whopping 75% support on an environmental proposal asking for greater reporting on methane emissions.
That's really helpful. Thank you, Rachel. And yeah, as Julia pointed out, it is important to note that even if a shareholder proposal doesn't pass, the percentages of support we're seeing these days are really interesting and important to make note of. If we now shift to, we've talked about, the board oversight, why you might incorporate ESG in compensation, the various market forces. Now, how are companies actually tackling this? Julia, what did we observe this year in terms of the use of ESG metrics among TSX60 issuers?
So the inclusion of ESG metrics, as we know, has been a topic for TSX60 companies for several years now. This being said, the number of companies to include an ESG metric in compensation has not significantly changed year over year. It's stayed relatively consistent. And we can see that on this slide. So we've seen the number of companies that are including ESG in their STIP increase by about 5% year over year, compared to a slightly larger 14% increase the year before. And we saw a similar trend in terms of the prevalence of inclusion in the LTIP. So we saw a 23% increase this year compared to a slightly larger increase the year before. 16 companies now include ESG metrics in their LTIP programs. And it's interesting to note that of these 16, I will note that 10 of these companies include ESG as more of a front-end condition LTIP metric, which essentially informs the grant value of both the short and long-term incentives. Whereas 6 companies have taken the step of actually incorporating an ESG metric as a back-end performance measure within their PSUs. So just to summarize, although the number of companies to include ESG hasn't significantly changed, a key theme that we've observed this year is really a shift in the focus of ESG metrics since last year's review. As companies' ESG strategies have evolved, their linkage to compensation and disclosure have become more robust as well, naturally. And so this year we've noticed a shift in both the type of metrics and the quality of disclosure. More companies are disclosing specifics around their ESG metrics, including targets, how performance was evaluated, and particularly the weight of the metric within their plan. Interestingly, we saw a 57% increase in the number of discrete metrics in the STIP this year.
And just to jump in here, the discrete metrics, my understanding is that refers to metrics with a specified weighting. So just what we would think of for a financial or operational metric incorporated into a scorecard, versus the basket that we're seeing here. You might have a portion of the scorecard that relates to ESG. You might have a whole bunch of measures within it, but you don't actually say how much each of them is worth. So that's the distinction. For the discrete, you say how much this metric is worth, and for the basket, perhaps you don't.
Exactly.
So why is it then that we're seeing such an increase in the number of discrete metrics in particular?
Yeah, so there are likely several factors at play here. A key is the company's comfort with the use of ESG metrics. So, as companies become more sophisticated in their measurement, forecasting, and assessment of ESG based measures, it would naturally follow that they would be able to provide more robust disclosure and would be more confident in the reliability of outcomes. An increase in discrete measures is likely an indicator of this, although I will say that discrete metrics don't always have clear targets that are disclosed, and in some cases, there are basket measures that are quite transparent as to their evaluation. An interesting example of this would be Canadian Natural Resources. So, for example, this company, it includes 2 carbon reductions metrics within a broader safety, asset integrity, and environmental basket within the scorecard. And while they don't disclose these metrics specific individual weights, they do very clearly outline in their scorecard their process for both target setting, which is kind of a year over year improvement type of mechanism. And then they also very clearly lay out the evaluation process and the result of each of those metrics.
Very interesting. And you also mentioned that the types of metrics have evolved since last year. How so?
Yeah, so while other more established metrics related to customers and employee base did not change meaningfully year over year, there were significant increases to environmental and EDI metrics in both STIP and LTIP programs, which we had actually noted in last year's review, as well as a lot of these companies had prospectively disclosed some of these changes. In the STIP specifically, we saw a 12% increase in environmental metrics and a 17% increase in EDI metrics year over year. I will note that we didn't track the use of governance metrics last year, so we don't have comparative data for fiscal 21, which is why that 0% is showing on the slide. It's not that 0% of companies actually had a governance metric in their programs. Interestingly, for the first time this year, more than half of TSX60 companies with an ESG metric in compensation have a measure related to carbon reduction.
That's really interesting. And that really ties back to what we're seeing in terms of the societal pressures and from all of these market forces wanting companies to adopt net zero targets.
That's right. A lot of companies have made connections to their net zero commitments in their disclosure of their carbon reduction metrics. That said, it is interesting to note that at this stage, most companies with carbon reduction metrics have not disclosed the specific targets that they're working towards. A lot of them will say that they're working towards an unspecified target or have a more process-oriented goal, such as establishing a greenhouse gas reduction roadmap, for example. But those at the more sophisticated end of the spectrum have gone so far as to define targets that are clearly tied to a net zero goal. And so a good example of this would be that it's illustrated very well in the case of the utility company Fortis. In fiscal 22, Fortis based 10% of its PSU performance on the reduction of scope 1 emissions. The target for this metric is actually a 3-year interim goal, which is linked to their longer term goal of 75% reduction by 2035. Looking forward to 2023, Fortis also prospectively disclosed the use of a multiplier on their PSU score, which will be evaluated based on achievement of corporate-wide executive representation targets for both gender and ethnicity. And this modifier will have the ability to adjust the PSU score by about 5% upwards or downwards. One other interesting example that isn't noted here on this slide is Tech Resources, which introduced a Sustainability Progress Index into its PSUs for the first time in 2022. One of the 5 measures within this index is a climate change metric, which is evaluated based on annual carbon reduction relative to a goal of reducing carbon intensity, by 33% by 2030. So another example of a company that has clearly linked its targets to a longer term goal at this stage.
And so when we think about these measures like emissions reduction and emission reduction by 2030 or 2050, that goes so far beyond the life of an STIP, even beyond a 3-year LTIP, in many cases, even beyond the tenure of a director on the board or of the management team. So you might assume that when you're implementing these types of emissions reduction metrics, that they would be in the LTIP primarily, like what Fortis did here. But that doesn't seem to be what we're finding.
No, you're right. So 44 out of 60 companies at this stage are using ESG metrics in the STIP versus only 16 that are using ESG metrics within their LTIP programs.
And why is that? Why do you think?
So there's likely a variety of reasons at play here, but I think a key one is really that these are relatively new metrics for companies. And as we've kind of touched on a couple of times throughout this session, we advise that companies only consider embedding a metric into compensation if it's rooted in strategy. Many of these companies are still developing their long-term ESG strategies. When instituting a new metric that you might not have a great ability to predict or build out targets for, it's often easier to review annually rather than setting targets and measuring multiple years into the future. And so we think that this will eventually shift a little bit towards LTIP. As you mentioned, Emily, they naturally have a much better alignment with some of these longer term metrics that are most critical at this stage, particularly a net zero 2030 or 2050 goal. But at this stage, still primarily an STIP.
And so do we think, did any companies disclose what are they going to be doing for 2023? How soon can we start to expect this change?
Yeah, so from what companies have prospectively disclosed, we definitely expect to see this trend gain traction in 2023. I can share a few interesting examples from what we've seen so far. So as you might already be aware, Suncor implemented a climate PSU in 2022, which is actually an LTIP instrument that is completely tied to the company's environmental objectives. For 2022, these PSUs were essentially assessed based on progress relative to the company's climate initiatives, so a more process-oriented goal. However, in 2023, the company has disclosed that, among other changes, climate PSUs will incorporate a formal target for emissions reduction by the end of 2025 as a step towards the company's 2030 goal. Another example would be Sunlight, who will be adding a sustainability multiplier that can adjust their PSU by about 10% upwards or downwards based on the achievement of 4 goals related to sustainable investment, gender and ethnic diversity representation, and greenhouse gas emissions reduction. And then another example we have here is Enbridge, who will be adding a greenhouse gas emissions reduction metric to their PSU plan weighted at 10%. The specifics of how this metric will be evaluated aren't available at this stage, but it'll definitely be interested to stay tuned and see more details on this next year.
Thanks, Julia. Now that we've gotten a bit of a sense of the Canadian market, Rachel, I'd love to turn it over to you. What are we seeing with respect to ESG metrics being integrated into compensation programs in the US?
Yep. And so, Summer Rossi has been reporting on trends on ESG incentive metrics for the last 2 years. And continuing with this series, we'll be releasing another set of reports later this summer. And so based on some of our initial research and findings so far, we are kind of seeing a similar trend to Canada, where we are seeing that leveling off in companies incorporating ESG incentives in their programs. And so 72% this year of the S&P 500 currently use ESG in their incentive plans, which is only slightly up from the 70% a year ago. And so, we're thinking that the S&P 500 in particular has kind of reached that breaking point. A saturation of the market has likely begun to reach. And so, we're going to see this slow down trend continue probably over the next few years. And so this slide shows in particular kind of the breakdown of different industries and ESG incentives within those industries. And so similar to prior years, financial services, industrials, and information technology companies have the highest prevalence of ESG metrics among the S&P 500. Utilities, energy, and materials have the highest proportion of companies with ESG relative to the representation within the S&P 500. And so when it comes to the breakdown between, short-term incentives and long-term incentives, similar to Canada, the majority of the companies are putting them in their short-term incentives. It's easier, again, likely still newer of a metric. And so a 1-year time period gives them a little more flexibility in how to measure. Approximately 11% of companies have both LTIP and AIP metrics, and then only 2% have LTIP metrics as the ESG metric in their program. And so, there is, again, that continued difficulty of how do I measure longer term goals. There's accounting implications as well when it comes to the LTIP program. And so a slower trend in the US, but we're likely to continue to see changes there. And so if we flip to the next page, so this slide shows kind of the breakdown of different types of metrics within the ESG category. And so similar to last year, human capital metrics or HCM metrics continue to be the most prominent category at around 68% of the S&P 500. No surprise here within the US, D&I continues to be the most prevalent type of metric, increasing from 46% to 55% in 2022. And so, what's kind of more interesting is the environmental metrics. And so that category increased from 23% to 34%. So quite a material increase. It's a little bit different than Canada, where Canadian companies are more focused on environmental metrics, but we are seeing kind of that push as there's a greater focus of US companies on carbon footprint. And so specifically that carbon footprint metric experienced a pretty dramatic increase year over year. And the rightmost category, where we kind of call it the other ESG metrics, that's pretty much stayed the same year over year.
And those are sort of the measures that we already saw for many years, right? The customer satisfaction, it's just a matter of now they're categorized as ESG.
Yeah, it's kind of those, I would say, beginner ESG metrics, per se, that existed a long time ago, but have now, to your point, been kind of brought under that ESG umbrella. Mm-hmm. And so if we flip to the next page, this is talking more about the various type of structures of ESG metrics. And so we saw a 17% increase in the number of non-discretionary metrics. So the top 3 columns of this slide. And, while quantitative discrete metrics, so row 1, is definitely the most rigorous of its kind, it definitely has its challenges, right? And so we are seeing a small uptick, but we do expect this trend to be a little bit slower moving. What's really changing behind the scenes is more and more companies are being pushed to have more rigor around their goal setting and disclosure. And so while the metric structure in the compensation program might be similar year over year, the discussion themselves and the underlying data supporting that assessment, the metrics have become a lot more stronger and rigorous. And so I think companies are beginning to realize, right, that they're going to lose credibility in the market and with their investors and shareholders if it's purely discretionary. And so more structured approaches to measure ESG metrics will definitely continue to be a trend in the US.
Thanks, Rachel. And as I think about the incorporation of ESG metrics, taking this a step above to the role of the board, approving the metrics and the calibration and the structure is just one part of this. Then you get to the need to set the targets every year and then evaluate the targets at the end of the year. And that is so difficult if a company is in the early stages of its program, or there is that need to have a qualitative assessment, informed judgment, discretion, whatever you call it. And I really think that this brings us back to, Kira, the need to have an effective board and qualified directors. And what have we seen in terms of director appointments in recent years?
Yeah, certainly. So there's been trends, and maybe we can speak both to Canada and the US, because there's different trends that are occurring in board appointments. Spencer Stewart just recently released their study of a sample of Canadian companies and looks at some of the appointments over the last year. And it's interesting. In the last year, we've seen a greater bias to recruit directors that have in-sector experience. So last year, about 3/4 of board appointments in Canada went to directors that are, formerly from industry, whereas historically that's usually only about 2/3. So it's increasing. And just anecdotally, I mean, we speak with management a lot when it comes to board evaluations and when we're conducting upward feedback. And I would say that management tends to appreciate industry veterans on their board. They can go to them to seek advice. There's a high degree of sort of built-in credibility when it comes to that. And, not to say that non-sector directors aren't valuable, they are. But it is incumbent on directors that don't have sector experience to really get up the curve and understand industry trends, understand the external environment in which it operates, and understand sort of the disruption that can or is occurring in the industry. When we look at diversity of appointments that's happened in the last year, Canada has trended, unsurprisingly, towards more year-over-year appointments to historically underrepresented groups, and a record 53% of appointments last year were women. Now, in the US, it's a little bit of a different story. And according to research recently done by Heidrick and Struggles, year over year, the US actually appointed fewer women to their boards. Fewer women or fewer director appointments went to historically underrepresented groups. And we started to see an uptick in those with CEO and CFO experience, which is historically one of the sort of core skills that boards have recruited for. Back in Canada, I think we still see a strong bias to those that have financial expertise or financial acumen in the way that the SEC defines it. And I thought it was interesting that only about 4% of director appointments last year came with a functional HR background. And I wonder if we're going to see that change in the coming years with the increased focus on social measures, human capital management. I think that's a space to watch, and I'm curious to see what happens there.
And so as we talk about which directors are being appointed to boards, how do boards refresh themselves? What is driving the renewal that can then lead to these appointments?
Yeah, we have a lot of discussions right now on board renewal, drivers of board renewal. A recent article by PwC found that there's they said that the director's reluctance to retire is the top reason for lack of diversity on boards. And that was based on a survey of executives. And beyond that, in the same article, it stated that there's a lack of trust that boards are actually removing underperforming directors. So 60% of executives and investors alike do not necessarily trust that boards will do so, will renew underperforming directors. When we look at some of the drivers of board renewal, inevitably we start talking about mandatory retirement policies, otherwise known as age limit and term limits. On the TSX60 last year, we found that about 23 companies, or 41% of the TSX60, does have an age limit in place. And it ranges from somewhere between 70 and 78 years. But it's worth noting that pretty much all of those companies also have the ability for the board to make exceptions to it. And then when it comes to term policies or term limits, it's about the same. So about 41% have a term policy. However, the board too can make exceptions to that as needed, and usually we see those numbers range from about 12 to 15 years. It's worth noting that these are blunt tools, putting in age limits and term limits. In an ideal world, we would have renewal that's based on two things: one, director performance and contribution, and two, strategic organizational need. I think in the future it'd be really interesting to hear directors saying, do we have the right skills on our board to execute our long-term strategy? And maybe that would imply that some very high performing, high contributing directors might need to reconsider their seat. Maybe it warrants, a new set of skills, for the next 7 to 10 years. So that's not a dialogue we're having right now, but I wonder, if we're going to start to see more of that. When we look at the actual stats around board renewal, on the TSX60 last year, I think we could say renewal is gradual. About 1/3 of TSX boards last year did not renew any directors. About 1/3 renewed one director, and the balance, the remaining third renewed 2 or more directors.
So for directors who are being recruited for boards, they're in high demand, how many boards can they serve on?
Yeah. So the CCGG, or the Coalition for Good Governance, have guidelines on this. And so for full-time executives, generally, ISS, Glass Lewis, and CCGG recommend that they don't serve on more than 2 outside public companies. For independent directors or non-full-time executives, the CCGG recommends that they serve on no more than 4 additional outside companies, and ISS Glass Lewis have a little bit of a higher tolerance at 5. Within the TSX60, we do see a lot of overboarding policies. About half of the TSX companies do have overboarding policies that state their directors can serve on somewhere between 3 and 4 other boards. And we also see audit committee overboarding policies. About half, or I believe it might be 1/3 of audit committees of boards have an audit committee policy. And this likely stems from a rule that to list on the New York Stock Exchange that you have to have an overboard. They have an audit overboarding policy, and there's also SEC guidelines around that.
Thanks, Kira. So as you know, we get to the end of the main part of our session and turn to Q&A. My takeaway is that it sounds like from both this conversation on ESG and compensation and on board governance, that there has been this shift to a focus on topics outside of just financials. Organizations seem to be prioritizing sustainability, social advancement, and really shifting how boards spend their time, how they think, and who's at the table. And I think it's kind of exciting that it seems to be there's a more sustainable approach to operating businesses and governing businesses in Canada. So that's sort of what I've taken away from today's discussion. I would love to hear from each of you what you would like our listeners to take away as the one little snippet from today. And maybe, Kira, we can start with you.
Yeah, sure. I think the first one is that board evaluations are not evaluations. They're really opportunities for boards to introspect and figure out where they can add more value and serve as a strategic asset to their organization. Right now, we don't have any way of measuring, the quality of a board evaluation. Mm-hmm. And, we need to start thinking about, how do we assess that? How do we know we're having the right, robust conversations and having a properly diagnostic board evaluation? I think that's really important.
Thanks, Kira. Rachel, why don't we turn to you?
Yeah, so, I think overall the trends that we're seeing at a high level is really similar to what we're seeing in Canada. So similar prevalence of metrics, more rigor, more data, and better disclosure. And so companies are beginning to understand that, adding metrics purely for signaling purposes are in some ways useless. And so, very intentional planning and measuring with some added flexibility through structured discretion as the ESG landscape continues to change will be important.
Thanks, Rachel. And Julia, over to you.
Yeah, absolutely. So I think a clear takeaway here is we can see that boards are having much more focused discussions around the inclusion of ESG metrics in compensation. So as it's been said, as Rachel just noted, there aren't necessarily that many more metrics, but the metrics are clearly much better positioned to drive strategic ESG outcomes. And as companies' ESG strategies are evolving, so are their compensation plans. We've seen an increase in environmental and EDI metrics. And while some of these are more process-oriented still at this stage, we do already see clear indications that they're moving towards a longer-term outcome with probably clearer targets set as well.
Thank you. So why don't we turn over to our Q&A period now? We'll get through as many questions as we can. We also had some listeners pre-submit questions, which was very helpful, and there's others here in the chat. So why don't we start off with Juliet? You know, Rachel had shared some insights by sector for the US, but we didn't touch on that for Canada. Could you share any of the trends we're seeing by sector for incorporation of ESG metrics among the TSX60?
Absolutely. So the types of metrics that we tend to see companies incorporate into their programs can often be generalized or grouped by industry sector. Traditionally, companies in the extractive sectors have tended to emphasize environmental metrics, while companies, say, in the financials or retail industries, among others, have tended to put a little bit more emphasis on social metrics related to their customer base and employees. And so to some extent, we can still see this trend this year with the majority of environmental metrics continuing to be represented in the plans of energy and materials companies. But that said, within the TSX60, the financial sector, for example, also has a very high prevalence of environmental metrics as well. The financial sector continues to have the highest prevalence of EDI metrics, as was the case last year. But I will say that this year, EDI metrics have become more prevalent across most industries. So the number of companies in the materials sector with an EDI metric has doubled from 3 to 6 this year. And the number in the utility sector increased as well from 1 to 4. So I guess overall, while we can still certainly see these trends this year, I will say that some of these broader metric categories are becoming a little bit more industry agnostic. Though, of course, there may be specific metrics within these categories that are more industry specific. So, for example, an environmental incidents metric is still probably most commonly seen in an extractive industries program, whereas, for example, financed emissions is one that we see more commonly at the banks.
Thanks, Juliet. Our next question here, I'm going to turn over to you. It's back to the whole concept of governing ESG. Which committee should oversee ESG?
Interesting. So I would say we had this conversation a lot more last year than we do this year. I think last year everyone was sort of saying, okay, wait, do we set up an ESG committee or do we not? And I would say that more boards than not decided not to set up an ESG committee, but rather put that into the full board. And it might not necessarily even be, say, put it in full board. It's that ESG is fundamentally an input to strategy and a lens that we persistently wear now. And so it's fundamentally embedded in strategy, which, you know, it essentially goes, is the responsibility of the overall board.
Thanks, Kira. Juliet, turning over to you for this one, and then Rachel, of course, feel free to add any thoughts. How do you know if it's the right time to put ESG in your incentive program?
Sure. So as we've discussed today, ESG metrics, really like any other incentive metric, should be rooted in an organization's strategy. I think that's definitely a key takeaway from this webinar as well, if no one said it. There is no single indicator, I wouldn't say, for the readiness of inclusion of ESG metrics in compensation. Rather, there are several factors that the board and management can consider when determining how a company could feasibly implement ESG into its compensation program today. We've actually developed an internal framework at Hugessen for this, which essentially is a current state assessment. That's what we call it. And it helps companies understand where they currently are in their ESG journey, and then the implications on what that might mean for an incentive program. This can be a really useful exercise because coming out of the assessment, companies can really identify gaps in their current capabilities and determine whether or not they wish to address these gaps in order to kind of reach their desired future state. Not every company may be aiming to be the market leader on ESG and compensation, so it's important to acknowledge that as well. But it really just gives a good sense of kind of what the ends of the spectrum are, and then areas that could be addressed or could be left the same. We actually have an article on this on our website that goes a lot more in depth on this topic and touches on what some of these specific areas that we cover in the assessment are. And so if that's of interest to any of our listeners, I would encourage to check that out as well.
Rachel, anything to add on that?
Yeah, I think very similar to what Julia has to say. Of course, Summer Brossi has their own frameworks and articles as well, and encourage you to check that out for a U.S. perspective. But generally, I would break it down to kind of three areas that you can assess your journey at. One of them being, what are the market pressures, right? Like Julia said, not everyone needs to be a market leader. Second part, and I would say the most important part, and should be first, is the business strategy, right? How does it connect to your business strategy? And the third part is, do you need ESG incentives to drive progress? A lot of times we ask the company the question, do you find that whatever commitments you have, whatever processes you have outside of compensation, is it already effective in driving progress? If so, is there really a need for ESG and incentives, right? So asking yourself that question will be a really important step as well.
Yeah, I like that last one, Rachel. And I think that's really interesting because we do see examples of companies that are quite leading in their ESG practices, but don't have ESG in their compensation programs. Maple Leaf Foods being one of them. It's just one that we toss out as an example. It's very interesting to hear that question added on to the thinking. So thank you for that. Another question that we received is, could you share more about EDI metrics? How are companies actually measuring diversity? Julia, why don't we start with you on that one?
Sure. So we've definitely seen a jump in EDI metrics this year, which we covered earlier on in the webinar. But that being said, at this stage, I'll note that there are very few companies who have actually disclosed a defined weight for their EDI metric, and there are even fewer who have disclosed very clear targets as to how this metric is evaluated. Similar to some of my earlier commentary on climate-related metrics, I would say that at this stage, many companies are disclosing that their metrics are tied to, for example, the development of an EDI strategy, or that they're tied to the strategy itself without necessarily elaborating as to what that strategy is and how the metric is evaluated. Another example would be, in some cases, companies have shared a higher level metric related to increasing diversity, for example. Interestingly, though, behind the scenes, we just want to note that behind the scenes, we would anticipate that many companies are building up their self-reporting and data gathering frameworks on these topics. So just because a company discloses a higher level increasing diversity target externally doesn't necessarily mean that there isn't robust data underneath this, just that it might not be externally disclosed. And we particularly think this would be the case for TSX60 boards, where this is even more of an expectation and often a core part of the talent strategy. Anecdotally, I think many of us have seen that talent and human capital management issues are getting more and more airtime at HRC meetings these days. And so that said, while there's only a small handful of companies that are explicitly disclosing the weightings and targets, there are a couple of examples. So for example, Fortis, who I mentioned earlier, will be doing so in their PSUs in 2023. Another example that comes to mind would be Algonquin Power. They have a discrete metric within their annual incentive program that is specifically tied to a target percentage, or 30%, of representation of women in leadership, which is interesting as well. But those examples are definitely in the minority at this stage.
Thank you. And Rachel, what are we seeing with respect to EDI metrics in the state?
Yep. Yeah. So as I've mentioned before, EDI or DEI metrics are definitely by far the most common type of ESG metric out there for the US right now, just given the social movements in the past few years. Most metrics don't have quantitative disclosed targets at this point in time. I think there is an additional level of scrutiny in the US with quantitative DEI goals. In 2022, Starbucks was sued for their, DEI policies and compensation metrics for, alleged illegal discrimination. And so given this lawsuit, I think some companies might be wary of the litigation exposure of having those quantitative targets. One potential example that we can kind of infer is Prudential, the company. who removed their DEI quantitative modifier from their long-term incentive program in 2022. And they've actually had that in their program for 2 years before that. And so there's no really formal rationale disclosed for the removal, but we think that it could possibly be because of the litigation risk. So, as more metrics are being pushed to be as more quantitative as possible, it's going to be important to, take into account all the factors in risk.
That's interesting. Always interesting to hear a U.S. perspective on those types of issues for sure. I know that there are more questions that we haven't gotten to, but this has been a great discussion. I want to be mindful of the time, so I'm going to bring this webinar to a close. I just want to say, these topics continue to evolve. We all know that boards are at different stages in their journey, and that's why I think it's so interesting to look at these TSX60 companies each year, the largest issuers in Canada, and see how they disclose their approaches to these issues. And it's always fascinating as well to see the largest companies in the US as some supplemental context here. So thank you so much, Kira, Rachel, and Julia, for sharing your insights with us. And thank you to all of you who attended this webinar today. Another reminder that a recording of this webinar and a copy of our slides will be posted to our website. If you have additional questions, please email them to us at email@hugessen.com. Both Hugessen and Semler, as we've mentioned, regularly publish Thought Capital on these topics, so I encourage you to check those out if you're interested in learning more. And we will do our best to get back to everyone whose question was not answered today. Thank you again, everyone, for tuning in, and I hope you have a great rest of your day.